Well, good afternoon and welcome. It's time for another Webinar Wednesday presented by the California State University Bakersfield SBDC or Small Business Development Center. I'd like to welcome you this afternoon. We are live from SBDC offices at the Mid-State Development Building in beautiful downtown Bakersfield. So I want to welcome everybody here today. We do have a pretty good webinar, I think, planned as far as topic-wise. I don't know about your presenter, but what we're going to do is provide you with a lot of different ideas and concepts and tools as far as business owners that really need to look at it this time of year from a financial perspective. So let's get going and give you a little bit of information about the SBDC program. It's a national program in all 50 states. There are about 1,000 of us centers across the country. And we are part of the Central California region, which is hosted by the UC Merced Regional Network. And we cover the middle part of the state, about 14 counties from the top up in Mono County, down to Kern County to the south, to the Nevada border, and to the Pacific Ocean to the west. In all, we have 5 centers in this area, in Modesto, Fresno, Bakersfield, San Luis Obispo, and in Salinas. So our territory, and this is a Webinar Wednesday. We also present for the UC Merced region the Brown Bag series of webinars. We do 2 a month. This is generally for the 3 counties. We promote to the 3 counties of Kern, Inyo, and Mono, which are our 3 counties. And if you kind of see from the southern part of Kern County up to the northern expanse of Mono County, you'll see why we developed this webinar series back in about 2013. And it's been able to provide us over 60 webinars and training topics to individuals in those areas. If you're from some other part, welcome. So at the SBDC, we provide high quality consulting and training, but I think this video can sum up best what we do. And take it away, video.
Small business development centers are the state's #1 resource for current business owners and aspiring entrepreneurs. Our 43 SBDC centers throughout the state offer no-cost expert one-to-one business consulting, training, and online courses in a variety of areas like startup assistance, debt and equity funding, attracting and retaining customers, international trade, and product commercialization. Our consultants are current and former small business owners, ready to assist you with even your most complex business needs. So, if you are looking for a loan or equity capital for your new tech venture, want to build a new website, need help starting or expanding your restaurant, or would like to sell your products internationally, make the California SBDCs your first stop. To get started, simply visit us online to find the location closest to you at californiasbdc.org. The California Small Business Development Center is ready to help your business start, grow, and succeed.
They say it much better than I can. So thank you for that. And we will actually move along. Another thing that is kind of pertinent in our SBDC world these days is informing our small business clientele of the Employment Development Department's mandatory e-file and e-pay for individuals or businesses that employ more than 10 people. So if you have more than 10 people, coming up on April 30th is going to be the due date for you to e-file, and you should have been e-paying as you go along. So if you need any other assistance in this area, you feel free to contact the SBDC. We can help you get up to speed with e-filing. Any of your SBDC branches throughout California, which there are 45 of them, or you could visit the EDD website. Okay, our webinar today, there's a good opportunity for everybody on the webinar to actually interact. And so please become familiar a little bit with your dashboard off to the right. You have an arrow to the right where it says questions. If you click on that little arrow, it'll drop down and give you the opportunity to ask a question. When we come to the conclusion of the webinar, I will attempt to answer those questions. So feel free to engage and ask a question. All of our attendees are in mute. You're muted today. So if you do want to acknowledge something or someone, either use the chat box at the bottom or use the question box, please. We encourage you at the end of today's webinar to complete the survey. A survey will pop up with just a few questions, and at that time, you have the opportunity to present not only your feedback from today's webinar, but also give you the opportunity to let us know what you'd like to see in future webinars. We've had webinars that have been presented from people on the East Coast, from unique backgrounds and topics that it's usually hard to do in a smaller geographic region. So if you have a unique topic, we'll try to get something ready for you. We're in the process right now of planning webinars for later this summer in the fall. So use that as an opportunity. And plus, my handouts, my slides will be available. You know the old saying, take my handouts. If you steal from me, you've stolen twice, I think is the old thing it says, which just is a way of regurgitating the information that we're going to go over today. So please do that. Upcoming webinars. We have a webinar every Wednesday in April this month. So take advantage of this opportunity to grab your lunch and get your learn on. We have next Wednesday, the Lean Canvas in your search for a business model, which if you recall is the business model generation canvas, those 9 boxes that really help you learn and succeed. We will have one of our lead consultants at the SBDC down here in Bakersfield, Tom Weir, along with our lead associate consultant, Erica Baltazar, present, and that'll be just a week from right now. Continuing on, we are going to have a noted author, Vernita Naylor, who's going to talk about selling to the government and also corporate buyers and institutional buyers such as utilities. She wrote the book, Get the Cheese, Avoid the Traps, which really is a blueprint for working with trying to increase your sales by working with the government. And then lastly, this month on April the 26th, we're going to have a webinar on the different topic of avoiding employee burnout. And employee burnout, as you may know, costs businesses millions, if not up to billions of dollars a year. And ways to avoid it and to engage employees and to try to assist them through any burnout phase rather than lose them. We will have Dr. Ariane Weiner, and that will be the 26th. So I will be the presenter today. Usually I'm in the moderating role, which is a role I like because now I'm pretty much done, but instead, not so much today. So I will transition to my other slide deck. And when we do that, away we will go. And start the slideshow, and here we go. So today, financial tools for your business. We thought this was a great opportunity during tax season when everybody has their financial information up front and foremost to really sit down and try to take a look at some of the areas and issues that they might have in their particular financial situation. So let's get on with it. For those of you that are associated with the SBDC program, you know, back on March 22nd, 2017, we had a day called Celebrate SBDC, which was National SBDC Day. So I was fortunate to be given an opportunity to contribute an article on SBDC, on how small businesses drive our nation's economy, to the Bakersfield, California, our local newspaper. And when I was doing this research, it was kind of fascinating that I found 3 surveys that were done toward the end of the year or the beginning part of 2017 that really showed a lot of optimism toward small business. And that hasn't always been the case going back to 2007 with the capital market meltdown and the financial market meltdown. And it seemed to have something to do with the election. So not getting into that at all, but noting that small businesses now have confidence that they haven't had in the past. And it's an opportunity for them to potentially grow their business despite, as I put in the article, that there has not been anything done as far as policy or regulation on two of the areas that small businesses are most concerned. And those two areas are, doing something with our tax code and also regulation. So it's kind of interesting when we start looking at the big picture. We look at the general economy and we look at things overall, and we look at realizing as small businesses that there is bigger things that impact our business. So all we can do is kind of focus on what we control. And what we control is our own individual business. So we have small business confidence soaring, which is good because we have entrepreneurs that see opportunity. And now is the opportunity to invest in not only land and building and equipment to grow their business, but also into employees and people. So this is why financial information is important to us. So at the SBDC, we like to think and we like to work with those that are building sustainable small businesses. And of course, a sustainable small business one is that's going to last over time. So in my opinion, there are two key factors for building sustainable small businesses. One of them is profitability. And if you don't have profit in your business, then it's going to be very difficult for you to continue and for you to provide the type of service or products that you want in your particular business. So profitability, and for a business owner, understanding going into the business what their needs are to get out of that business. So if profitability is, I've seen and worked with businesses that people are content with pulling as little as $10,000 a year and surviving on that aspect of it. But then there are others that come to us and say, gee, I need to make $150,000 a year, or I really can't be in this business. So profitability is one of the keys for building sustainable small businesses. And then the other key is solvency. And that is staying liquid and staying a ongoing concern and being able to fight off creditors or any other issues that come up. And oftentimes these are issues that are out of our control as small business owners and operators. So solvency, the ability to stay capitalized and stay in business, is another factor that is obviously a big factor when we talk about sustainable small businesses. So we have profitability, that is, of course, the earned income, and the solvency, again, is the ability of the business to meet its financial obligations at the end of the day. So let's do this. Let's get started with our kind of looking at our tax return. And we'll pull up a fictitious tax return here. Mr. Bucky Smith. And Bucky is a contractor and does a lot of good things here. So one thing that we see with Bucky is that we've opened up to his 1040 form, and everybody should be fairly familiar with the 1040 form, even though you don't do your own taxes yourself. So what we see is getting down to the income section of the 1040, we see that where there could be wages. Generally, with small businesses, we go over here to business income or loss. And it looks like Bucky enjoyed a fairly decent year with $67,000 of income. That's net income that flows all the way to the bottom line. He had some other issues, and then he came up with his total income here on line 22. We will get into this line 12 business income because this is one of the big factors and one of the more important forms for small business owners if they're a sole proprietorship. And we're going to use the Schedule C today because we could use an incorporation return such as an 1120 for a C Corp or S Corp or an LLC, but we're going to just try to keep it a little more simpler and a little bit easier to explain rather than when we get into other entities. So Bucky is a sole proprietor. He could be a sole proprietor with Millie, his wife, Millie and Bucky, as sole proprietors, but what they are is a sole proprietorship, and so they file Schedule C of the 1040. Millie is Bucky's second wife. As you see, he paid a little alimony to Michelle back in the day. So we have Bucky and Millie Smith get to the second part of their 1040. I'm sure this is pretty. This isn't breaking news to you, I understand. Basic standard deduction. We come down here to the taxable income. So whereas we started up here with total income of being around $65,000 for the year, we come down here and the taxable income is only $18,000 based on itemized deductions, the large alimony expenditure, which is something that hopefully you aren't experiencing, and then also your exemptions and other worksheets. So we come up with the tax amount there, kind of go down through here. You all know about your self-employment tax, which is based on about 15.3%, which are both shares of the Social Security and Medicare portion. So that's going to be 15%, as you know. And that's not even including the income tax. That's another tax that you pay at that time since you aren't having Social Security or Medicare taken out of your check. So then we drop down to where we've got the tax there for and income tax, a little bit of income tax. You'll see that only $1,823 of that is income tax, and it's a low tax year for Bucky, as we'll see in a few moments, of $11,357. Now, a lot of people, what they do is when they get their income tax return, they immediately look at the amount that they owe, or they look at the amount of their refund. And I really want to encourage you to really look at the total amount of the tax that you pay. And that is something you want to look at over time. Now, it's April, and this isn't a tax planning webinar, and it's difficult to do tax planning in April, but I encourage you to seek out your tax preparer, your CPA, your financial person who does your taxes or assists you, or your advisor, and do some meaningful tax planning in December before you get to December 31st. There are a lot of steps that you can take there to reduce the amount of tax that you owe or pay. So there's Bucky's 1040, and kind of moving on to some of the other forms. This is our Schedule C. And let's pull up the Schedule C. Pretty straightforward. Bucky's in the construction business. It's Bucky Construction Company. He has an LA address here, LA County. So what we're going to start off with is his gross sales or revenue. And what is important to know about the Schedule C is that many of you probably know, it closely parallels a profit and loss statement or an income statement. And it is really the income statement for your business, the official one, because it is the one that banks and lenders and landlords and other people that are going to be assessing your financial health are going to look at. So you can generate a nice profit and loss statement off of your laptop, and oftentimes when you go for funding or other uses, it's going to be the official document that's used. So here we have about $500,000 in revenues, and then we have it subtracted by the cost of sales. We'll skip down here to the bottom and show you where cost of sales is. This is just kind of where it's entered into this particular software. And it's going to include lines 37 and 38, your cost of labor and your materials and supplies. And so what its cost of sales are in this example is basically what it costs you to generate these sales. And the balance of what's left is called your gross profit. It's called your gross profit because it's not your profit from your business. It's just your profit before we get to all the other operating expenses that are listed below. So we'll go quickly through these expenses. We'll look at, normal expenses for this type of business. We're going to see advertising. We're going to see car and truck expenses. A big one is depreciation. And when you meet with your tax person in December, depreciation is really one way that you can shape what your tax situation is going to look like 4 months later. For example, in December, you can buy equipment, you can buy vehicles, you can buy rolling stock, you can buy whatever. And you can immediately expense it with this section 179 that's listed right here next to line 13. And this gives you the opportunity to actually write it off in 1 year. Usually our assets, what we do is we purchase them. They're going to last us 5 years, and we're allowed to write them off over 5 years. So if I go out and buy, say, a Bobcat tractor, and my tractor costs me $50,000, and it's going to last me 5 years because I use it pretty hard, or Bucky does, then you get a $10,000 deduction each year. But this gives you the opportunity to take it all in this one period. Then you see other expenses that are pretty common to this type of business. We come down here to the total expenses, and that leaves us with our tentative profit or loss. In this case, it's a profit. And that's our Schedule C. We start with our revenue. We have our cost of goods sold, which is the cost of our labor. It's the cost of our materials. Leaves us with our gross profit or gross income. We subtract all of our total expenses, and we have our profit. Okay? So let's go back now, hopefully, and get a different form. One form that I really, really want to go over that I really think a lot of people miss out on, and of course it's down here on the bottom. And all of these are tax forms, but it's the tax history report. Because what this does now is it gives me the opportunity to go back and look over the last 5 years of my tax history. And form is in summary. It's not something you file with the IRS. It's only for your purpose, but it gives you a snapshot. It gives you one page, and it gives you a 5-year history on one piece of paper. So what I can do is I can go in here and I can see my total income. Now, I could have had some extraordinary income amount. Maybe I sold a stock and reaped a large profit. So it could have jumped my total income. But one thing that you see from 2012 to 2015, that Bucky's taxable income, his total income was amazingly consistent. And in the construction industry, that's not common, but in this particular case, it is. So you see this year that it's down significantly, and you go in and you see why it's down. And when you peel back the layers, you see on the Schedule C's from previous years that there was over $500,000 in sales. And so if you look at the profit and loss of this business, it is reduced significantly by 1/3 because sales dropped. So this is something that you really need to look at on an annual basis when you're done. Other things that are important here is to see the total amount of tax that you pay. So there's your taxable income, but underneath it is the tax, and you see the tax is substantially higher in these 2 years, which are 14 and 15. So what we have is we have a number of things that are happening here. The main thing is that the filing status changed. You went from a married filing joint return to a single return that created a higher tax bracket. Okay, so that's a look at our tax return. So now let's go back to where we were. And we did just that. We looked at some of the key forms. We talked about depreciation, and we looked at the 5-year summary. So now let's get into what is financial analysis. And essentially, financial analysis is going to help business owners determine, based on the information and data that they have in their financial statements, it's going to provide them with more information to make better decisions. So that is the point of financial statement analysis, is looking at our financial statements to help us make decisions in the future. And that's why we do it, is to make better decisions. But it's also to assess our financial health and performance of the company, particularly to external uses. To external uses such as a bank that you're looking to get a credit line with, a landlord that you're looking to rent property from, etc. You'll even be providing external information to your workers' comp carrier, who will want information on that and will probably audit your records just to maintain an insurance account. So there are some limitations of financial statement analysis. Even though I'm a huge fan, I must warn you that sometimes a strong financial statement doesn't necessarily mean you have a strong financial future. There can be external reasons why that might not happen. There were some people that had some pretty incredibly powerful financial statements in 2006 and went through the Great Recession a few years later and the financial market meltdown, and it changed dramatically. So financial statement analysis will help you in that particular situation, but there are limitations. Also, it could ignore a price level increase. Oftentimes, our financial statements are essentially interim statements, which are only for a part of a year. So what are the financial statements we're going to talk about? We're going to talk about the income statement. We could talk about the balance sheet, a statement of retained earnings. We could talk about the statement of changes in financial position, changes in working capital position, changes in cash position. These are all accounting forms, generally for larger businesses once you get into a statement of retained earnings, because you need to be a corporation there, and some of the other factors. For our purpose today, what we're going to do is we're going to focus not only on this owner equity pie, which shows how you distribute assets and other things, but we're also going to focus, there we go, on those that are most vital for small business. And those are going to be the profit and loss statement. And we've kind of covered that, I think, in sufficient detail with the tax return. But there are also comparable financial statements that are valuable, where you can compare your financial statement, your income statement, for example, from a prior year, or from a prior month, or from a prior period of any that you choose. So that's helpful too. The balance sheet. Balance sheet is something that's similar to most of us that we've filled out on our, as far as a personal net worth form. That statement is one that is included in most mortgage applications. So on that form that I think many of you are familiar with, the personal net worth statement, what you'll find is you list your personal assets and you reduce that by the liabilities. So you have the things that you own, your banking account, your other assets, perhaps other real estate, automobiles, expensive jewelry, and you offset that by what you owe against those assets. You owe a mortgage, you have a car payment, etc., or you have a balance due on the car actually. So that will give you your personal net worth. A balance sheet is the same thing. We're not going to cover a balance sheet in great detail. Balance sheets intimidate small business owners, but if you just look at it similar to your personal net worth statement for a business, it's a really helpful way of trying to get you through that. We are going to focus on cash flow, and we're going to focus on the cash flow statement and forecast. We get asked a lot of questions at the SBDC, like what is the biggest reason that small businesses fail? And I like to tell people the biggest reason small businesses fail is because they run out of cash. Cash is important. Cash is king. Cash is really one of the most important things in operating a small business. Oh, sure, there could be external factors. There could, like the ones we mentioned with the Great Recession. There could be a phenomenon that's going on, like say with businesses that have changed due to technology, like the internet has impacted several industries, dozens of industries. So there's a lot of factors outside of that, but the bottom line is essentially somebody runs out of money. That's why they're closing the door. Sometimes they close the door before it's too late and lose everything, and sometimes they liquidate and they just move on with life. So here's an example of the cash flow, of the actual cash to cash cycle. And this would be essentially from a retail perspective, where you purchase inventory, you sell the inventory, you collect it from your customers, and then you pay for the inventory. Oftentimes when you see a cycle like this, you see perhaps a need for a credit line from a lender. Credit lines are very helpful for this because you might purchase the inventory on credit 60 days ago. And if you bought it 60 days ago before you sold it, you're already 60 days out of paying for this. And it might take you another 10 to 20 or 30 days, depending on your credit terms or if they're cash sales, to collect it from your customers, of which then you pay for that inventory. So oftentimes external financing becomes an issue. We'll touch on financing actually a little bit later, but let's go over cash flow. And let's go right to the example. Let me give you an example here on a cash flow forecast. So what we have is we have a fictitious company, just your sample company, LLC, the address, the type of business they're in, and a little bit about this. I think of all the things that we're going to talk about today, and I know a profit and loss is important. Obviously, your Schedule C, you have to file for taxes, but forecasting and being aware of your cash situation is vital to the small business success. So in this particular example, we're a wholesale business. And what we have here to start with is we have $10,000 of our cash on hand. So we're starting off January 1st with $10,000 in the bank. And let's just look at this entire month of January, and we'll go through a month because once we get to the other month, it's just repeated. What we want to look for is we want to look for our cash on hand, though. And look what's happened at the very beginning. We start with 10,000. And if you just look at the cycle or trend, we're out of money in July. How are we going to meet our obligations? How are we going to stay solvent if we're out of money? We're not only out of money, we're at a negative amount out of money. So let's go through this process. This is a wholesale business. They start off with $10,000 in the bank in January. And through January, they have sales on credit. Now, they have very, very tight credit terms, so they collect that in the entire month also. We'll see the same thing there with cash sales. So there's no loan or there's no injection of the owner's business. And so what you also will see is you'll see there's the total cash that's now available through the month of January 2017. By adding that to our $10,000 of cash on hand, and it gives us $38,000. Okay? Everybody with me? I don't see anybody nodding their head. So let's move on to cash paid out. We have $38,000 we know in January. Could be it's what we're going to have for the entire month. By the end of the month, we know we will have had $38,000, or at least that's what we're going to project. Now, being a wholesale business, we resell products, so we have actual purchases, and those are the purchases of the sales. So that's purchases of inventory, $14,500. We have potentially drivers that deliver this, and other employees of $98,500. There's the payroll expense as far as taxes. It could be insurance, or we could have workers' comp down here in insurance. You decide. We're going to have repairs and buy other supplies. We have a miscellaneous column to handle contingencies. We pay for advertising and accounting and legal support. We have an office expense, and so all these expenses come down here. You'll see that we don't have anything in for interest or principal payment or property, so we are most likely renting. Or, in this particular case, they could own their property because you don't see any rent. So that brings us to our subtotal of all of our expenses, of which we then will subtract by the $38,000 up here, and that brings us down to $8,124. And we go to the top of the month into February, and we start all over again. So what have we learned? What have we learned in this example? We've learned that, number one, that our cash is diminishing, and we need to do something, because it's not going to be an ongoing business if we don't have the cash to continue. So what we do is, you notice between June and July, we have a 10% increase in the sale of our goods. So we've just thrown a 10% sales increase in. We assume that nobody has really left our business. And so everybody's stuck around through the 10% increase, which is questionable. Our purchases stayed the same because all we did was increase the sales price. And voila, the difference, if you see, is about $1,000 per month improvement, or 800 or 900 in our bottom line or cash. Cash flow forecasting, extremely important, extremely vital. We have resources here at the SBDC. We have a fine crew of associate consultants, which are essentially CSUB students. Many of them have financial backgrounds. They would like to talk to you about this if you have any questions. Okay, let's move on and move back into our PowerPoint here. And so cash flow over the longer term. Enough about cash flow. We could talk about budgeting too. If you do a cash flow forecast, essentially you're doing a budget. But as far as what we go, 13% of small businesses budget. You really need to budget as we move forward. So 13% budgeting. I don't want to spend a great deal of time on budgeting because we've covered a lot of that in cash flow. But the budget process and getting assistance budgeting also is available through the SBDC. And again, I apologize. This is a ton of information to cover in a very short period of time. If you want more information on budgeting, learn it from the slides or learn it from other assistants. So another interesting thing that a lot of small businesses don't look like when they're thinking about doing a financial tune-up is the amount of energy that they expend in their business. A lot of grocery stores, older ones, markets, mom and pops, are typically high energy users because they use refrigeration equipment in their deli case and their freezers that are older than obsolete. A number of the utilities, and in this case we'll use PG&E as an example because we're familiar with what they use, is they have actually a program to help small businesses replace some of the obsolete equipment. And the thing is it comes right back down to they will provide you with a 0% loan. They will provide you with some rebates. And all of this, there are conditions. You need to really learn more about the eligibility, such as you have to be a PG&E customer example. But if you go to the box in the right-hand corner, that's what I want to talk about. I want to talk about doing a little financial analysis to determining if it's worthwhile for your particular business. And in this case, what we're doing is we're employing what we call a simple payback method. And a payback method is this simple. We have a project cost of $10,000. And then what we're doing is we're estimating what our energy savings are going to be each month. So after the rebate, it went down to $7,500. We're going to save about $300 a month on our utility bill because we have much more efficient equipment. And so then in 25 months, essentially that equipment is paid for. And that $300 that you have in energy savings, it drops right to the bottom line. So not only are you doing good things for the environment by saving electricity, saving some of our energy, but you're also saving $300. And this is just by using a simple payback method. And our consultants can work with you on that as well if you need to be. But it's just taking the cost of the project, the amount of time to get paid back. But the point a lot of people miss is they're going, 25 months, I'll pay 25 months and then it's paid for. But then that equipment might last you for 15 years and you're enjoying that same $300 savings each of those months. And they have a few success stories about people. It could be lighting, it could be efficiency. But really, this is a program that we're going to really focus on coming later in the spring. And we're going to really look for businesses that really could use some energy savings and try to help find that savings for them. I talked a little bit about pricing earlier, and we had a fantastic webinar by Bob Bonacorsi. Bob is a certified pricing professional, and it opened our eyes to a lot of things. In our cash flow forecast, you saw what can happen with strategic pricing. We increased our sales 10% and our cash flow went up $800 a month. Now, again, I know that's assuming that you didn't lose any customers. And one of the things that Bob will tell you is that one of the strategic pricing methods that you should employ is to make more numerous, smaller price increases. If you raise your prices every 6 months, 1.5%, not only are you getting the compound benefit out of that, but you're essentially raising it a little more than 3% a year. If you hold off like too many of our small businesses do, and they wait 5 years and then they'll increase prices 15%, it really alienates customers. I understand that oftentimes you're dealing with a commodity, and a lot of these commodities, are subject more to market conditions. But Bob has here his 10 most common pricing mistakes, and I'm only going to go over a couple of them, such as number one, where companies base their prices on their cost, not their customers' perception of value. Big point there. You go off your cost, you add a little bit to it, but it really needs to be on what your customers value that for. What do they value your service, or actually, what do they value your product? Very important topic there. Your customer's perception of the value is how pricing needs to be determined, rather than just the cost or what it costs you or what your competitors charge or what the marketplace will bear. Important safety note. So you can get all 10 of these by completing our survey at the end of the webinar. Unfortunately, based on time, we're not going to be able to go through them all. We talked a little bit and gave you a little bit of example about the payback method and pricing tools, how pricing and investment can tie together. Important things to look at: pricing, energy usage, efficiency, your cash flow. All very important things to look at this time of year because it's tax time and now's the time to look at it. Let's talk about capital. In my poll that I forgot to give you guys, one of them was your most, you know what? It's never too late, as they say, is it? So let's do a poll right now. So we have a poll question for you. And let's do this poll. What is the greatest financial challenge facing my business? And let's launch this poll. And ideally, I would have submitted it to you at the beginning, but getting old. What can I say? So the greatest financial challenge facing my business. And the poll is now open. So go ahead and take the poll. Select one of the following. My net profit is too low. I need greater sales. My expenses are hard to control. I need more capital to grow or sustain my business. I'm making too much profit. My taxes are too high. Oh, I like that one. I don't really feel sorry for you because I'm sitting here thinking I'd love to be paying $1 million a year in taxes, income taxes, that is. So again, look at that, and we're going to close the poll in just a couple of minutes. Again, my profits are low. I need greater sales. My expenses are hard to control. I need capital, etc. And let's close the poll and let's share the results. And two big winners out of that. People need greater sales and also need capital to sustain growth. So good to know. We're going to get on to the capital aspect now. Greater sales, we'll cover that briefly as well. So we will hide those results. We'll move back to our PowerPoint. And so you need capital. 38% of you are telling me you need capital to grow or sustain your business. We talked a little bit about credit lines when we were talking about cash flow. And so when we're talking about capital, we're not only talking about capital you might need for these reasons and these purposes, but also we're talking about capital that you might need as far as either debt, either short, intermediate term, or long term. And another really crucial point is when you need capital and you think you need a loan, is to match the assets that you're acquiring with the debt. incredibly important, and something we're not seeing a lot of these days with the acceleration of online lenders that have very short payback periods. So if you're purchasing a piece of property, land, and building, and you're paying it off over 3 or 4 years, you really need to do it over a longer term, unless you have really, really incredible cash flow. Because if not, that's going to create a problem. So you really need to fit it to the type of loan that you have. And then also you need to look at is what is going on as far as debt or equity. So we have actually a lot of different programs that are out there as far as debt or equity, as far as the considerations go. So debt, we're talking about traditional funding is, are you bankable? And what we're finding is lenders are doing less from a traditional small business lending perspective, which kind of brought on the online lenders. And so we're looking at a lot of equity type of arrangements. For example, here at CSU Bakersfield, we have a team of crowdfunding for a crowdfunding team of our associate consultants. And they will meet with you to determine what is the best way to crowdfund. Is it the donation or rewards? Is it equity crowdfunding? Could even be debt crowdfunding. So those are ways of resources that we can benefit you along the debt and equity perspective as well. Change in ownership. The other thing is when we move out of this, and it's of course important to manage, but a lot of people, when we don't have higher sales, we really need to look at what you're doing from a marketing perspective. And marketing is oftentimes a big picture. So 38% of you need higher, greater sales. So what do we need to do is we need to evaluate what you're doing, not on a financial perspective, more or less initially. We need to look at what you're doing from a marketing and social media. So from the marketing and social media, you'll see we have a couple of upcoming webinars on May 10th and May 31st on using Facebook, and also on traditionally marketing and using social media with that. So those are a couple of things, but really what you need to start looking at is you really need to look at your traditional and your social media marketing to effectively manage the sales component of it. I'm sorry to report nobody was making too much profit and their taxes are too high on our poll. So, and we did have 53% of you vote. So maybe next time or maybe next year. That's always something to aspire to next year. Okay. We have some things that we're just not going to be able to get to just because of the complexity, and one of them is financial tools of financial analysis. And, it's basically using your financial ratios. That's something that we can go through on an individual basis. And I do know that there is a ton of stuff here. So what I'm trying to do is trying to hit on the most important ones today and try to work in and fill in the blanks for later. So we're not getting into any type of ratio analysis. This is something that at CSUB through our School of Business and Public Administration is taught on, is about a semester-long class for finance majors. But we have those finance majors that are going to be available to you in your business if you so desire. So let's look at some of the other factors before we have to get to the questions for today. And, we looked at some of the profitability ratios, some of the things like that, liquidity. But let's move on to the questions as we're running out of time. The first question is, will this webinar be recorded for review? And thanks for the question, Mike. As Mike, you might know, many of our webinars are recorded. It just depends if the moderator remembers to push the record button or if we have any other technical problems today. I believe he pushed the button. So this session is being recorded and will be at our website at csub.edu/SBDC. And I know there's a lot of information. The slides will be available. That's another question that's come up. Yes, we will have the slides. The webinar will be available. If you want some of the resources that are available, we can have those also available for you for download. For example, we went through the cash flow forecast, the Excel spreadsheet. And I will gladly make that available if you put it in the survey as well. It's a question about credit lines. And when is the best time to get a credit line? And from my standpoint, the best time to get a credit line is anytime you can get one. And, sometimes people are in great financial shape, and it's something to aspire to if you're not in great financial shape now. But when you get there, get a line of credit. Go to the bank then where you're strong. And it's only a few $100s to keep it open, and you have it open and available. The problem that we run into with credit lines is too many people will use those as a term loan. And credit lines are used for the purpose that we illustrated earlier. They're made for when you have shortages of cash, filling that need, paying interest for the amount of money that you use then and moving on. We have a webinar on government contracting. That's coming up in a few weeks. A lot of the contractors that come in here, they're looking to do something with maybe high-speed rail. They're maybe wanting to do something with our defense bases in eastern Kern County, China Lake, and Edwards Air Force Base. And they come in, and one of the things that I want to let them know right away is that oftentimes with these government jobs, you're not going to be paid for 45 or 60 days. And yet you're going to be putting material and labor into the project. And you're going to need a credit line or some resources in order to bide you by. So that's a perfect example of where a credit line is handy. A couple of other questions. What is a good company to go to for taxes for small businesses? Well, I really don't have a good answer for you. I think that you maybe use some of the review. We have a short list of a half a dozen that we know that are pretty good, and I can email you that. I think that if you use anybody who's a certified public accountant, you pay a little bit more. You know what you're basically going to expect. But you know what? This is why they have review sites. So I'm gonna defer that one to Yelp and some other review sites. Let's see. So little time, so many questions. One on cash flow. Cash flow is important, but is it the most important? Well, I know I did make that statement earlier that it is the most important, at least in my opinion. It is the most important financial statement you'll have. That's not regulated and required by law. But also, I encourage you also to look at comparable profit and loss statements. A lot of us, what we do is we get our taxes done, and that's the only profit and loss that we see that is on the Schedule C. So when you have that one tax return, you have that one profit and loss, that makes it even more important to compare it to prior results. Now, if you're working with an accountant, which I highly recommend, or another financial person, and you're getting them done on a routinely basis, what I like to recommend is that people go over that with your representation. Some people I was actually making the recommendation, don't have your taxes done in April. Have everything paid in April, and then when your accountant has more time later in the year, have them complete your taxes where they can explain to you a lot of the things that we talked about today. So I hope that kind of answered your question. Well, I'm soon going to hear a bell ring. Hey, there it is. It's 1 o'clock. I want to thank everybody for attending. We have upcoming webinars, and contact your local SBDC throughout California if you have any other questions or issues regarding this. Lots of webinars coming up, lots of times. There's lots of help out there. Please, if you need some assistance, find it. There's technical assistance for those out there. So normally I would say for someone else, but it's for Kelly Bearden saying, have a great day. Goodbye now.